Rule number one, the good trade is a hard trade. You know who taught me that? A delightful old man. He was one of the first market wizards, Michael Steinhardt. Do you know him, Larry? I know him so well. He's 90 these days, 91. He's still trading. My word, he's made a hemp. He trashed those indices for 25 years. And he was the inspiration for me, in fact, buying oil right at the lows. That was a classic Michael Steinhardt trade. And please Google Michael Steinhardt. He was one of the original market wizards. He has got cast iron you-know-whats in his day. He was something. Guys, the good trade's a hard trade. I'm not saying it's intellectually difficult, okay? In fact, as I said on Friday, the thicker you are, the better. But it's just difficult to do. The market's roaring down, 3 big red bars. Puts the fear of God into you, and now some idiot tells you must step in and buy it. You know, it's really, really difficult, okay? Very difficult to do. So that's a characteristic of a good trade. If the trade seems easy, there's a good chance you're just about to be sexually violated. And that's fine if you like that sort of thing.
Hello, traders. Welcome back to the ComLucro channel. In this video, we break down what you just heard from David Paul and expand it into a complete framework. This is not just a motivational message. It is the foundation of how professional traders trade, starting with mindset and execution. What David Paul explained highlights a core truth in trading. The best opportunities rarely feel comfortable. That is why trading psychology and successful trader psychology are central themes in this video. Many traders search for the only trading psychology video you need, yet struggle because they focus on strategy before understanding behavior. Throughout this video, we connect psychology with real market mechanics. You will see how supply and demand trading strategy, the liquidity concept in trading, and volume work together to reveal intent. This creates a clearer path to understand market structure and avoid reacting emotionally to price movement. By the end, the goal is to help you think and act with more clarity and patience. This approach reflects the structure behind any complete Forex course, from beginner to professional, and supports traders who aim to build consistency and learn Forex trading, how to make steady profits over time. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Now that you understand why good trades feel uncomfortable, the next step is learning how professionals bring structure to that discomfort. The difficulty of a good trade is not random. It comes from acting in alignment with the broader market context, not with short-term emotion. In this next clip, David Paul explains how professional traders use the higher time frame to define direction and why pullbacks, not breakouts, are where controlled risk and real opportunity begin.
Rule number 2, I want to fade the short-term trend in the direction of the long-term trend. So fade the short-term trend in the direction of the long-term trend. So what I'm saying is that I've got a long-term trend in place and I want to buy a pullback and let it go again. Guess what that is? A, B, plus it's C, D. Okay, so I wonder where I got that from.
What David Paul just explained shows that professional trading starts with directional alignment and patience. By fading the short-term move and trading in the direction of the long-term trend, traders stop reacting emotionally and begin responding to market structure. This approach keeps risk defined, reduces impulsive decisions, and allows traders to operate with clarity, even when price moves quickly. Once direction is clearly defined, trading becomes less about prediction and more about execution. That is where many traders still struggle. Knowing the trend is not enough if entries are poorly placed or driven by fear of missing out. In the next clip, we shift from direction into precision and explore how professional traders choose their entries, how liquidity influences those decisions, and why the best opportunities often appear where most traders are forced out.
The third rule, I want to put my entries where the masses put their stops. How's that? On your way home, I want you to pass a building site. And on the building site, you pick up a brick. Okay? You take that brick home, and tomorrow when you're about to put on your first trade, you decide where you're getting in. Just before you press the button, you pick the brick up and you go, smack it against your head. That puts you into the present moment. And here's what I want you to do. Rather than buying the market at where you thought you were going to buy the market, put an order in at where you were going to put your stop and see how often the damn thing goes to your stop. Okay? So place your entries where the masses place your stops. And this is another thing I learned from Larry, is that the best trades occur when the masses have been stopped and trapped. So even if you don't get in at the cusp of the turn, if you can look back and see, just obvious on the chart, that lots of people would have bought there, and then the bloody thing went down again, nailed them, and then reversed. If you get in after those people have nailed, then you're in a much better place, okay? And of course, that's difficult because we're scared of missing out. At least I am.
What David Paul just explained brings execution into sharp focus. Professional traders do not enter where it feels comfortable. They enter where risk is better defined, and where most traders are emotionally vulnerable. By placing entries near where the masses place their stops, traders align themselves with liquidity rather than chasing price. This approach reduces fear of missing out, improves timing, and shifts execution from impulse to intention. It is one of the clearest examples of how professionals think differently from the crowd. Once execution is understood, the next step is learning how to read the market itself. Entries based on liquidity only make sense when you can interpret what price and volume are communicating together. In the next clip, David Paul introduces the foundations of Richard Wyckoff's work and explains why volume, when read correctly, reveals intent, validation, and early warning signs that most traders completely overlook.
I'm going to talk a little bit about Richard Wyckoff. And I know many people say that volume doesn't work, but volume, especially in the stock market, is a great, great edge. And if I have the discipline in the stock market to wait for volume coming to the party, I can get my hit rate up to 80% when volume hits me between the eyes. So Richard Wyckoff died in 1934. His work was carried on by many, many people. I bought his original course in the early 1980s, and I went through it. And please do not buy Wyckoff's works and his course unless you're prepared to put a great deal of effort into it. I'm not saying you won't do that, but it's certainly not something that you're going to take in on a Sunday afternoon while you're putting back 3 or 4 Frosties, okay? That's not going to work. He writes in the, like the King James's version of the Bible, it's all these and thys, really, really difficult going as Gann did. So his 3 laws, supply and demand, cause and effect, effort and result. So the price action on the chart must reflect the volume action below it. If the volume demand is large and the price move is large, then price is acting rationally. If they don't, then that in Wyckoff terminology is known as a non-validation. And that's a leading indicator and an opportunity for profit. So, for example, a large change in price and low volume. So you get a breakout on low volume, then that's a non-validation. And markets on any time frame, rising and falling volume, need to be carefully watched. And all of this came from the old fellas, Livermore, Wyckoff, and a whole host of traders of that era just reading the tape. The only thing that was on the tape was price and volume. So what Wyckoff tried to do in his chart reading and his course was to try and give the retail trader the ability and the education to be able to read the tape in terms of price and volume. And I love the Wyckoff stuff, I really do. And it's a complicated theory. In the stock market, there's a gentleman called Stanley Weinstein that's written quite a few books on the longer term aspects of the Wyckoff technique.
What David Paul just explained introduces one of the most important shifts a trader can make. Instead of relying on indicators or fixed formulas, Wyckoff focused on understanding the relationship between price and volume. When price and volume move in harmony, the market is acting rationally. When they diverge, it creates a non-validation that often signals opportunity or risk ahead. This way of reading the market requires patience and observation, but it gives traders a deeper understanding of intent rather than surface-level signals. Understanding Wyckoff's principles is the foundation, but applying them requires a different way of thinking. In the next clip, David Paul explains how professionals actually read price and volume in real time, without trying to over-quantify every detail. He shows how simple observations about range, closes, and volume can reveal whether the market is healthy, exhausted, or preparing for change.
When I've presented this before at the institutional level to a bunch of quantitative traders, they were not happy because they wanted something that they could quantify exactly. And Wyckoff is not like that. And he said in his course, look at the last 20 bars of trading in any time frame and make a judgment on the range. Is it high, average, or low? The position of the close. Is it near the high, mid-range, near the close? And volume, high, average, or low? That's what he looked at. Now, you're more than welcome to quantify that even more. And certainly some of our vector vest people quantify volume around a 50-day moving average of volume, higher or lower than a 50-day moving average of volume, and we can scan for that on vector vest.
One of the key ideas David Paul reinforces here is that market reading is not about precision or formulas. Wyckoff's approach was built on judgment, context, and disciplined observation. By evaluating range, where price closes, and how volume behaves, traders gain a practical sense of market health without overcomplicating the process. This shifts focus away from prediction and toward understanding whether price movement is supported by real participation or simply drifting without commitment. With this observational framework in place, the next step is learning how to interpret confirmation and warning signs. In the next clip, David Paul explains how professionals identify validation and non-validation by comparing price movement with volume. This is where traders learn to recognize strength, exhaustion, and potential turning points, not just in charts, but across any market and time frame.
In terms of validation, if you've got a big range bar with above average volume that closes in the top 80% of the range or the top half of the range, then all is good. And in that moment, whatever that moment is, 5 minutes, 1 hour, 1 day, 1 week, 1 month, then you should do your best to let it run. And similarly, if you've got low volume and a very small range, that's also good. That's fine. So small result, small effort. That's good. Everything's in sync. Now, where you get a non-validation is that if you get a big bar on low volume. Now, that can happen easily at a breakout, and it can happen easily at the end of a trend where the price keeps running on low volume. Now, let's look at the housing market at the moment, certainly in the UK and from discussions with Kathy in the US as well. We've got a situation where prices are rising and volumes are rising. I don't know what it's like in Denmark. Now, sooner or later, you'll find that volumes will stay up there and prices will go flat. That's the next step, and that can happen very quickly. So we'll get if you examine the results carefully, you're going to get a non-validation between the volumes of homes sold and the prices. At the moment, everything's going rosy, but it changes very quickly indeed at the top of a market. That's the next step. Just watch out for that, any of you that are involved in property. Just look at the monthly stats. At the minute, volumes are rising, prices are rising. Certainly in the UK, that's the case. The next step will be that volumes stay up there, but prices just don't go. In other words, you get a flood of sellers into the market. All that volume can't push the price up anymore. And then all of a sudden you get a turn. That's a non-validation, happens in every market. So now this is an interesting one. And this happens frequently at the end. And this is what many traders call a volume climax, where you get lots and lots of volume and no movement. And that's the next step in the housing market, in my opinion. Now, what's happening here? Now, this is going to be easy for the Danish people. Let's say that you're in your car on a miserable cold night, right? And there's lots of snow around. And you're going up a hill. Use your mind's eye here. You're going up a hill, and you put foot, as they say in South Africa, and you're moving up, and all of a sudden, the wheels start to spin on the ice. Yeah? And you put foot again, and you go a little bit further, but you can't make any traction. And then you put foot again, but it doesn't matter how hard you put your foot, you slide back. And that's what's called a volume climax. Lots and lots of volume, no action in the price. I think that's probably a quarter to 2 quarters away in the housing market, in my humble opinion.
At this stage, the market begins to reveal whether a move is healthy or fragile. When price expands with volume and closes with strength, participation is real and continuation is possible. When price moves without volume support, it becomes a warning rather than confirmation. These non-validations often appear near breakouts or late in trends, showing that effort is no longer producing result. Volume climaxes make this even clearer. When heavy participation fails to push price further, signaling exhaustion rather than strength. Learning to recognize these moments helps traders protect profits and avoid staying too long in moves that are already running out of energy. Once validation and non-validation are understood on single bars, the next layer is seeing how these signals develop over time. In the next clip, David Paul explains how professionals read sequences of bars instead of reacting to isolated events. By observing how range and volume evolve across multiple bars, traders gain early insight into whether a trend is strengthening, weakening, or preparing to change direction.
Gets more interesting because we can now look at a multi-bar. And if you've got, let's say, 3 bars up, you've got good ranging bars, the range is getting bigger on the bars and volume is rising, all is good. All is good. And the same on a down market. But you can get a non-validation quite easily. There's the price rising. We've got a big range bar, but the volume can't come to the party. That's a non-validation. And that's saying that there's something up here. You've got to be careful. Now, the mistake that I made at the outset with volume is that I actually tried to react to the volume. And volume's not like price. You can't react to it immediately. It is a subtle warning of the future. That's all it is, a heads up. So it could take 3, 4, 5 bars for the change. Similarly in the housing market, it could take many months for it to top out before it changes direction. And if I see a non-validation, it's a reason not to add to a position. It's in fact a reason to actually lighten a position. As price rises, folks, volume should rise with it. And as price pulls back, we should see volume drying up. Simple as that.
Looking at the market through multiple bars changes how traders interpret strength and weakness. Instead of reacting to a single candle, professionals observe how range and volume evolve together over time. When price expands and volume confirms, the move has energy. When range increases but volume fails to follow, it becomes a warning rather than an invitation. These subtle shifts do not demand immediate action, but they provide early information about when to stop adding risk, reduce exposure, or prepare for a possible transition. This patience is what separates structured decision-making from emotional reaction. Once traders learn to read volume across multiple bars, the next challenge is trusting pullbacks instead of fearing them. In the next clip, David Paul addresses one of the most common psychological conflicts in trading. He explains how volume behavior during a pullback reveals whether a trend is healthy or failing, and why falling volume during retracements is often a sign of continuation rather than reversal.
The great question, of course, and you all must have said this to yourself, the rule says buy a pullback, but when the pullback is occurring, your little mind is moving to the future and it's saying to yourself, well, this may not be a pullback at all. This could be a change in trend, and I'm going to buy it, and I'm going to feel like a right proper plonker. So if you see the price pulling back on falling volume, that's a very good sign that we're still in a bull market. And that's the primary definition of a bull market. Rising, ranges expanding on rising volume, pulling back on falling volume. If I see that, then I'm quite happy to buy into that market, and you can see that as clear as day. So those of you that give volume a bit of a hard time, on an intraday chart, if you see a couple of bars pulling back on falling volume, that's a great place to add. See a couple of bars pulling back, tiny little bars pulling back on low volume. Remember, a low range bar should be accompanied by low volume. Pulling back, tiny little bars, great place to add. If you see a pullback and rising volume, then the game can be up. Now that's a sign that we've got more likely not a retracement, but a change in trend.
Fear during pullbacks is one of the biggest reasons traders exit good trends too early. When price retraces, the mind naturally jumps to worst-case scenarios and starts imagining a full reversal. What David Paul explains here reframes that fear through volume behavior. Pullbacks that occur on falling volume show a lack of opposition, not weakness. They reveal pauses in participation rather than aggressive selling. Learning to recognize this allows traders to stay aligned with the trend, add risk selectively, and avoid mistaking healthy retracements for trend failure. Understanding the theory behind pullbacks and volume is powerful, but clarity comes from seeing it applied in real markets. In the next clip, David Paul walks through classic Wyckoff examples and real stocks to show how rising volume on advances and falling volume on pullbacks reveal accumulation. These practical cases turn abstract principles into something traders can recognize and apply with confidence.
This I took out of Wyckoff's 1929 course, and I had the artist, again done in 89, I had the artist put the color around it, and if you can see, it broke, and it broke on rising volume, and then it pulled back on falling volume. That's what a market should do. If this is accumulation, you should see rising volume in the upswings and falling volume in the downswings. The VictorVest people, we've just had an example of that on Bloomsbury Publishing, where it went sideways for the last year. And in upswings, good volume, and the downswings, no volume at all. And Bloomsbury produced very good results the other day, and it flew up by a third. So the real world is something quite different. That's an American stock, Nucor. I'll explain this setup in detail, but I think Dr. Brooks did a good job of talking around it. It came back, it traded this double bottom, or as we'll see in a second, a spring, pushing up and rising volume. And at this turn here, you can see that it came down, took out the low, and reversed on above average volume. That's a very good sign. There was a little bit of trouble here. It then went sideways on medium volume and then pushed back up again. But that was the clincher for me, this trade here on the long side.
Seeing Wyckoff principles applied to real charts brings clarity to everything discussed so far. When rising volume supports advances and falling volume accompanies pullbacks, accumulation becomes visible rather than theoretical. These patterns show how strong hands build positions quietly, allowing price to pause without collapsing. Real examples like these remove guesswork and confirm that market behavior repeats across different assets and time periods. This is where traders stop memorizing rules and start recognizing structure through experience. After understanding accumulation and confirmation in controlled examples, the next step is seeing how these signals behave inside a live trend. In the next clip, David Paul breaks down a complete real-world trade, highlighting how volume acts as an early warning system. This example ties together trend direction, volume behavior, and decision-making under uncertainty, showing how subtle signals can protect capital and signal when a move is reaching exhaustion.
That's been my best trade of the quarter. CF Industries, these are the people that are responsible in the UK for all of the CO2 in our cool drinks and beer. And there's a shortage of it again. They've got a plant up in the north of England, and the government had to bail them out to keep them here. Otherwise, we would have run out of CO2. At the moment, there's a shortage of mineral water again, or fizzy water again. As you can see, we broke up on rising volume, and we went sideways on falling volume, and then it breaks on high volume. That's just a cert. Now, there's a big trend there. The fundamentals on VectorVest were great, and it's in the throes of a long-term trend. And Tom, if you'll remember, I still use an 89-day moving average for the trend. 21, 55, and 89, although I don't put them on the charts that often because I've been looking at them for so long that I know where they are. But if you need a hand to define the trend, 21, 55, and 89, where they all cross, I call that a bow tie, where they all cross. Okay, so now this thing moved up, and this is a bit of a worry here. You see? Look at that. Huge volume. That's where we were at the moment. Couldn't close at the top. I'll show you the rest of the chart in a second. So that's an example of trade entry. I took all the trades that I'm talking about here, I've taken them myself. And there's where we were. Remember the bar that closed halfway up its range on big volume, and it came back after that. And then one thing that happened, which was a heads up that worried me, is that the price fell on rising volume. And that was a heads up. I still took the breakout, but on the last little bit of the trend, the price is rising, but the volume couldn't come to the party, and then the bloody thing fell out of bed. So that last bit, there was two bits of evidence here. The price fell, and those red bars and rising volume, that was saying this trend looks complete. Then it breaks and has a last hurrah on falling volume, and then it gaps down. So there was, and that's what volume's like, folks. It's a subtle signal. It took me a long time to work this out. I was actually taking action on volume very quickly indeed, but it's a subtle signal that the trend is in a bit of.
This final example brings everything together in real time. Inside a strong trend, volume does not shout. It whispers. Early warnings appear when price continues higher, but volume stops confirming, showing that participation is fading beneath the surface. David Paul highlights how these subtle shifts do not demand immediate exits, but they signal caution, position management, and awareness. This is where experience replaces reaction, allowing traders to stay objective even when price action still looks convincing on the surface. Throughout this video, the focus has been on how professional traders think before they act. From accepting that good trades feel uncomfortable to aligning with the higher time frame and executing where liquidity sits. Each concept builds a structured approach to decision-making. Trading becomes less about prediction and more about preparation, patience, and context. By introducing Wyckoff principles, volume analysis, and validation versus non-validation, the market starts to reveal intent rather than noise. Pullbacks, consolidations, and even climactic moves stop being confusing and begin to tell a story. These tools allow traders to read participation, recognize strength or exhaustion, and manage risk with clarity instead of emotion. Taken together, this framework shows that consistency is not created by a single setup or indicator. It is built through disciplined observation, structured execution, and the ability to respond calmly as conditions change. This is how professional traders survive uncertainty, protect capital, and allow their edge to play out over time. The principles you just saw do not stop at market structure or volume. They extend directly into mindset and behavior, which is where consistency is either built or destroyed. This is why the work of Mark Douglas fits so naturally after this discussion. His ideas focus on how traders process uncertainty, manage fear, and stay disciplined when outcomes are never guaranteed. To deepen this psychological foundation, I am going to show a short clip from another series here on the channel. It connects directly with everything you just learned and explains why consistency only becomes possible when mindset supports execution, not the other way around. Let's take a look. Lesson 1. Accept uncertainty. Traders lose because they crave control. They wait for the perfect setup, the perfect signal, the perfect moment. But the market does not owe you predictability. Trying to control outcomes leads to hesitation, emotional decisions, and unnecessary pressure. The most liberating shift is to embrace uncertainty and stop asking the market for guarantees. When you understand that you cannot control individual outcomes, you begin focusing on what truly matters. Uncertainty becomes part of the game instead of a threat, and your job becomes managing probabilities, not searching for perfection. Lesson 2. Think in probabilities. This is one of the most important ideas Douglas presents. Trading is not about being right. It's about thinking like a casino. A casino does not care about one hand of poker or one spin of the roulette wheel. It cares about the edge repeating over hundreds of trials. As a trader, your responsibility is the same. You are not trying to win every trade. You're trying to execute consistently so your edge plays out over time. Even a strategy with a 55% win rate can create wealth when executed with discipline. These ideas reinforce a simple but critical truth. No strategy works in isolation. When traders accept uncertainty and think in probabilities, execution becomes calmer, discipline holds under pressure, and consistency stops being accidental. Psychology is not an add-on to trading. It's the foundation that allows every edge to work over time. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.